Hello everyone, and welcome to our yet another discussion on the taxation of rental income. The taxation of rental income forms the wider discussion of property income that we have been having from lecture 1, 2, and 3. Now, in this lecture, we are going to look at how the rental income of a resident individual in particular is taxed. In this lecture, of course, we are going to look at a number of things, and among those, we are going to look at some of the key terms given the line of rental income for an individual as per Section 2 of the Income Tax Act. And then we shall move into a discussion on the imposition of rental income tax. And of course, as we have been discussing in our previous lectures, we've mentioned that no citizen is supposed to pay a tax unless it is imposed by an act of parliament. So we are going to look at this particular section that imposes rental income on the individuals. Number 3, we are going to look at some of the issues that we consider in the determination of rental income by resident individuals. Okay, we're going to look at the rental income by resident individuals. And then number 4, we are going to look at some of the important steps that you're going to take in determining or arriving at the tax liability in regard to the rental income derived by resident individuals. So in number 4, we shall look at those very important steps, and then we shall wind up our discussion with the review of an exam type question, how the examiner will structure this area in the examination. So moving straight into our lecture, we want to know what are those different key terms given in the Act in regard to rental income. Now, some of these terms are examinable. So the first one is rent. And of course, according to Section 2 of the Income Tax Act, we are saying that rent means any payment, including a premium or like amount, made as a consideration for use or occupation, or the right of use, or the right to use or occupy land or buildings. So here we are saying, according to Section 2 of the Income Tax Act, rent means any payment that you make, including a premium or like amount, made as a consideration for use or occupation of, or the right to use or occupy land or buildings. So that is our very nice definition here, coming from section number 2 of the Income Tax Act. And then, of course, we have rental income. We are going to be discussing rental income in our lecture. So we want to know what is rental income. So here we are saying rental income, according to Section 2 of the Income Tax Act, rental income in relation to the person for the year of income means that total amount of rent derived by the person for the year of income from the lease of immovable property in Uganda, with the deduction of any expenditures and losses that you have incurred in respect of that very property. So the section brings out this very nice definition here of rental income. And of course, we are seeing that rental income is basically that income you're going to derive from letting out your immovable property. In particular, if you're talking about the resident individuals, we are talking about income you're deriving from leasing of immovable property that is located in Uganda. And of course, as you can see in our definition here, the government or URA will allow you a deduction of any expenditures and losses that you have incurred in respect of this property. So before you are taxed, that consideration is going to be made for the expenditures and losses you have incurred. So these are the very nice definitions put across in Section 2 of the Income Tax Act. And of course, I'm picking out only these two. You may appreciate the fact that Section 2 has numerous definitions given for the different terms, numerous definitions for the different terms given in the Income Tax Act. So for purposes of this discussion, I feel that these two definitions are important, and we need to understand them before we move into the full discussion. So going into bullet number 2, the slide, we are saying that the immovable property we are talking about here will take the form of land and buildings. We are focusing on land and buildings here. So we continue by, of course, looking at the imposition of rental tax. As I've mentioned, at the beginning, I mentioned that no citizen is supposed to pay a tax unless it is imposed by an act of parliament. So in this discussion, we are saying that Section 5, subsection 1 of the Income Tax Act imposes rental tax and provides that subject to and in accordance with the Income Tax Act, a tax shall be charged for each year of income and is imposed on every person who has rental income for the year of income. Subject to and in accordance with the Income Tax Act, a tax shall be charged for each year of income and is imposed on every person who has rental income for the year of income. So, as you have seen here, definitely this is the sovereignty of the government, and the government here is informing us that if you have any rental income for the particular year of income, then you're supposed to pay a tax, and this is our rental income tax. So it means that this is a legitimate and therefore should be paid with will by all those individuals indicated here. So we continue after looking at the legality of this tax. We continue by looking at the rental income that is derived by resident individuals. And of course, in our very first lecture, we looked at who is a resident individual. I want to go back to that here. You can still go back to our lecture platform and pick up the lecture and understand who is a resident individual. And again, here we are saying that the resident individual definition is still given in section 2. You can still go and pick it in that section there. So we want to know how is the rental income treated for tax purposes here. So in our slide here, we are saying that the rental income earned by an individual is separated from other incomes earned by the individual for rental tax computation purposes. The rental income earned by an individual must be separated from other incomes earned by the individual for rental tax computation purposes. So the meaning of this is that if you are employed, okay, if you're under employment, your employment income is going to be taxed separately from the income that you are deriving from your rentals. So that is the meaning of this here in bullet number 1. In bullet number 2, we are saying that an individual who earns rental income is supposed to furnish a return of the gross income for each year of income, not later than 6 months after the end of that particular year. So we are saying that an individual who earns a rental income is supposed to furnish by law a return of their gross rental income for that year of income, not later than 6 months after the end of that financial year. So we are saying that if the financial year is ending on the 30th of June 2020, you are expected to furnish and pay your rental income tax, okay, by the 31st of December 2020. So that is the duration given to you to organize your books of accounts and then determine your tax liability. And of course, this is going to be the gist of our discussion in this lecture. So we continue again by saying that the expenditures and losses incurred by the individual in the production of rent shall be allowed as a deduction under the Act for any of income as provided for in Section 22, subsection 1, Part C of the Income Tax Act. Expenditures and losses you incur as an individual while you're producing that rental income is allowed to you as a deduction as per the Income Tax Act for any year of income. Of course, you have to refer to Section 22, subsection 1 of the Act. And of course, we bring that section here so that you don't struggle a lot looking for it. We are saying that according to that section, Section 22, subsection 1, Part C of the Income Tax Act, you as a resident individual, you are going to be given a maximum of 20% of the gross income as expenses. The section gives a resident individual a maximum of 20% of the gross income as expense. And of course, we are going to look at this in our exam type question to determine how much expenses are allowable for deduction if you have derived your rental income. So we continue again by, of course, saying that the rental income of a resident individual earned from a resident person for the year of income is charged at a rate of 20% of the chargeable income in excess of 2,820,000 per annum. The rental income of you, the resident individual, earned from a resident person for the year of income is charged for tax purposes at a rate of 20% of the chargeable income in excess of 2.8 20,000 per annum. So of course, as we bring this one into our discussion, I don't want you to begin asking where I'm getting all these figures. I'm getting these as provided for in the Income Tax Act. I'm picking all of these from the Income Tax Act. So we continue by looking at those important steps that you're going to take in computing the rental income for an individual, the important steps in computing rental income tax derived by resident individuals. So what are those steps? So the important steps in step number one, we are saying you determine the total rental income that the individual has received, okay, from renting of immovable property. You determine the total rental income received by the individual from renting of the immovable property. So if the person has 5 rental units, you determine how much they have derived from those 5 rental units. In step number two, we proceed to deduct 20% of the rental income as determined in step number 1 above as an allowance for expense and losses incurred in the production of the rental income. So here what we are saying is that after getting the total rental income in step number 1, get 20% of that. That is going to be what the law is going to allow you as an allowance for expenses and losses. So you're going to be allowed a deduction for that 20% because they believe that you have incurred some expenditures and losses while you're deriving that rental income. So step number 3, we are saying we then proceed to deduct the threshold, the 2,820,000 from the remaining rental income as established in step number 2. So after removing the other 20% allowance in step number 2, we then remove 2,820,000 from the remaining rental income. So the meaning of this is that the 2,820,000 is not a taxable rental income. So anyone who earns 2,820,000 as rental income in a given year is actually exempt from tax. That income is not taxable. So that is the threshold that you're going to deduct in step number 3. And then finally, we move into step number 4, where we determine now the rental income tax, which is given at a rate of 20% for the amount established in step number 3. So the figure that remains after the treatment in step number 3 is going to be taxed at a rate of 20%. So this means that the Income Tax Act for now, according to the prevailing laws right now, the tax that is charged is 20%. So these are the very, very important steps that we take in determining the rental income tax liability of a resident individual. And of course, we are going to support our discussion with an activity, and this is activity 3. In activity 3, we have a gentleman here, James Golola, who has been constructing 3 residential units in Tinda, which were completed in January 2019 at a cost of 80 million. And during the year ended 31st of December 2019, James earned gross rental income of 28 million and incurred security expenses of 3 million, maintenance of 5 million, legal fees of 3.5 million. This was the only income for James for that year of income. So we are required by the examiner to advise James on his rental tax liability for the year ended 31st of December 2019 and when his return will be due for filing and of course subsequently payment of the tax liability. So I want you to go to our lecture platform and just download the solution to this activity so that we are in position to also gain that skill of how to determine the rental tax liability for a resident individual.